What's up, everybody? Genix Dividend Investor here. In this episode, I'll go over each of the dividend stocks in my multi-million-dollar portfolio and share whether I believe them to be undervalued, fairly priced, or overvalued, which may help inform your own research as you decide whether now is the time to buy, hold, or sell. Please feel free to watch my previous videos where I explain how a stock's price trends towards its intrinsic value, which is a very important investing concept to understand. And to kick things off, I want to first thank everyone who watches my videos, as I just hit my 6-year anniversary on YouTube since my first video went up on August 8th of 2019. I've really enjoyed connecting with so many people and having the chance to share my investing experiences in the hopes of encouraging more people to invest. Investing allowed me to achieve financial freedom and retire in my 40s, well ahead of the typical retirement age, and I want everyone to have the opportunity to build a better financial future through smart investing and budgeting. Anyway, if you're new to my YouTube channel, then welcome, and if you want to see my entire dividend portfolio in fidelity, then watch a video I did recently called my $3.3 million dividend portfolio, $131,000 of dividends per year. Feel free to use the timestamps to jump to wherever you want, but I urge you not to skip ahead as you'll miss some stuff I consider valuable. Now, some of the reasons why I've been able to build a good-sized portfolio include because I started young, didn't quit when my portfolio got hammered in bad markets, and that I tended to buy when things were cheap or reasonably priced, and I often waited to sell until things were expensive. I like doing lump sum buys when something is cheap, and I almost always avoid investing when something is expensive, and I'm usually okay with dollar cost averaging into reasonably priced single stocks as well as with ETFs. Now, it's true that even expensive stocks can keep shooting up, so just because I've had success with this approach doesn't mean it's the right thing for you. I mean, right now AI is scorching hot, so companies like Microsoft and Nvidia and AMD and such can keep going up even though they look expensive to me. The reality is that companies can stay overpriced or underpriced for years, kind of like we saw when valuations were too high in the dot-com run-up, and then we saw how we probably overcorrected to the low in the lost decade. That all being said, I've tried to model my investment strategy somewhat after the most successful investor of all time, Warren Buffett. His core approach involves calculating a company's intrinsic value and ideally buying the stock when it's trading below that estimate. This principle is at the heart of value investing, a strategy he learned from his mentor Benjamin Graham. And in addition to focusing on intrinsic value, Buffett looks for companies with strong and predictable earnings, durable competitive advantages, often called moats, competent and shareholder-friendly management, and a margin of safety between the stock's price and its intrinsic value. He basically aims to buy great businesses at fair or bargain prices and then hold them for the long term. Now, sometimes people mistakenly think that trying to wait for a stock to be cheap is the same as market timing, but it isn't. Market timing usually means trying to predict short-term market moves and making buy or sell decisions based on those guesses. But to me, that feels way too speculative and easy to get wrong, since markets are notoriously unpredictable and often react to things like macroeconomic shifts, interest rate changes, and geopolitical events. Buying a stock when it's cheap, on the other hand, is about focusing on the intrinsic worth of individual companies, essentially finding undervalued businesses based on their fundamentals. It involves analyzing things like cash flow and growth potential to figure out if a stock is trading below what it's actually worth. The idea is that over time, the stock will move closer to its true value, and in my experience, that's exactly what tends to happen. Of course, there is risk with all investing strategies, and misjudging intrinsic value or assuming a cheap stock will recover when it might not is something to be aware of. So in short, market timing is about guessing the market's next move, while buying cheap stocks is about identifying value regardless of broader market conditions. I frequently will do a discounted cash flow or DCF calculation to determine a stock's intrinsic value or true worth. In this video, if the stock's price is 10% or more lower than the intrinsic value I think it's worth, then I'll call it cheap. If it's 5% or more higher than its intrinsic value, then I'll call it expensive, and if it's between those 2 points, I call it fairly or reasonably priced. And remember, all this is speculative based on my calculations and assumptions about future growth and such. Okay, now I'll jump into my stocks, and I'll go through my tickers alphabetically starting with Apple, and I'll just call out a few interesting metrics, though I'm not going to talk about all the key risks they face or dive into financial trends that are normally critical to understand before you invest. Apple isn't a classic dividend stock, but it has been one of my favorites as I've made over 500% on it, even though it's only a stock I've held for a relatively short amount of time, at least compared to some of my dividend stocks that I first purchased long ago. Apple is 2.56 of my portfolio, and I calculated that it's reasonably priced right now. But it is struggling to be the powerhouse innovator it used to be. I mean, Chinese competitors are getting better, Apple has lost much of its brand appeal, and it feels like they're relying too much on past success. Their overall growth is weak, and services are the main bright spot. Its current price when I did this video is at $212, and my 1-year estimated intrinsic value for it is $217, which means that I expect it to go kinda sideways. Analysts are more bullish on Apple as their 1-year target is at $235, which is about 10% up from where it is today. Note, the analyst estimate I'm using is an average or median of usually a bunch of stock professionals, which should help weed out edge case folks that might be overly bullish or bearish. I think Warren Buffett sold much of his Apple stake partly because the company hasn't shown strong growth from new product innovation. That being said, he refers to Apple as one of Berkshire Hathaway's most valuable assets, which makes sense because it makes up nearly 22% of the total portfolio, highlighting its ongoing importance to the company. Apple has a super low 0.49% dividend yield, a great 14% payout ratio, a mediocre 5.2% 5-year dividend CAGR, and an okay 13 consecutive years of dividend increases. Apple is clearly focused on driving more cash into buybacks than dividends right now. Next up, I have AbbVie at 5.21% of my portfolio, and I find it to be reasonably priced. My 1-year target intrinsic value is at $200, which is 4.7% higher than it is today, but analysts are more bullish as their estimates are 11.5% higher. AbbVie has a 3.48% dividend yield, a 62% payout ratio, a 7% dividend CAGR, and an awesome 52 consecutive years of dividend increases. Next up, I have BTI at 4.33% of my portfolio, and I find it reasonably priced. My 1-year target value for BTI is 5.5% higher than it is now, whereas analysts on average are bearish with a negative 23% target from here. There's a wide variance on what analysts think will happen with BTI, with some bears predicting a $33 1-year target, while some bulls predict $66. Now, if you want to have your mind a little bit blown, check out this year-to-date total return chart on Seeking Alpha, which puts BTI as having returned an astronomical 51%, blowing out the SP 500, which has done an awesome 9%. So that's probably why some analysts think it's time for some pullback reality, which is understandable. BTI has a nice 5.85% dividend yield, a 73% payout ratio, a low 3% dividend CAGR, and 22 great consecutive years of dividend increases. I put in asterisks on dividend increases because those hikes are based on British pound increases, not adjusted for dollars. Moving on, next up alphabetically is Caterpillar at 2.6% of my portfolio, and I find it expensive. I estimate it to be almost 10% down a year out, but analysts are less bearish and have it 3% down from here. Hopefully we're both wrong and it continues to move up. CAT has a low 1.4% dividend yield, a healthy 27% payout ratio, a nice 6.9% dividend CAGR, and a great 31 consecutive years of dividend increases. Next, I have Colgate-Palmolive at 1.72% of my portfolio, and I find it reasonably priced. I've got it worth 1.9% more than it is a year out, whereas analysts are way more bullish than me with estimates of 15.6% up from here. Hopefully they're right. CL has a 2.4% dividend yield, a 55% payout ratio, a low 3.2% dividend CAGR, and an awesome 61 consecutive years of dividend increases. Next up is Chevron, which is 2.29% of my portfolio, and which I find expensive as my 1-year target estimate is about 7% down from where it is today. Analysts are bullish as their 1-year target is up 4.9% from here. Chevron has a 4.38% dividend yield, a 71% payout ratio, a 6.1% dividend CAGR, and 37 consecutive years of dividend increases. Nice. Next up is my first ETF, and it's an income ETF called DIVO. I didn't give my ETFs intrinsic value estimates, but analysts are bullish as they put DIVO up 6.5% a year from now. It's at a 4.58% dividend yield and has 4 consecutive years of dividend increases as it's a newer ETF. After that, I have Duke Energy, which I find expensive, and my 1-year target for it is down 7% from here, but analysts are quite bullish as they predict 10.5% upside from here. I'd probably believe them as I could see all the AI and other energy demands pushing Duke up more than I estimate. It's got a 3.62% dividend yield, a 67% payout ratio, a low 2% dividend CAGR, and 20 consecutive years of dividend increases. After that, I have Enterprise Products Partners, a master limited partnership that is 4.3% of my portfolio, which I find is cheap. I have a bullish valuation of over 27% from where it is today, and analysts are also bullish as they have it up almost 15% from here. It's got a hefty 7% distribution yield, a 1.6 coverage ratio, a 3.7% distribution CAGR, and 26 consecutive years of distribution increases. MLPs pay out in unit distributions, not in dividends, even though in casual conversation some people will call them dividends. MLPs are structured as partnerships, not corporations, and its owners are referred to as unit holders rather than shareholders. The unit distributions they pay out basically represent shares of the partnership's income. Distributions are often treated as return of capital for tax purposes, reducing your cost basis in the MLP's units. Once your cost basis is reduced to zero, any further distributions are taxed as capital gains. This tax treatment differs from corporate dividends, which usually taxes qualified dividends or ordinary income. So since I hold EPD in my taxable account, it means my payouts are all at $0 of federal income taxes for the next 6 years until my cost basis gets to zero, which is pretty awesome. Now don't take any of that as tax advice or accurate, because I'm definitely not a tax guy, but that's my understanding based on the tax professional that did my taxes. I make over $10,000 a year from EPD in my taxable brokerage account without having to pay federal income taxes on it, which I absolutely love. MLP distributions generally come from the partnership's operating cash flow, not from earnings and profits like dividends from corporations. This structure is one of the reasons MLPs are attractive to income-focused investors, as they can provide high tax-advantaged payouts. However, they also come with additional complexity such as K-1 tax forms, which is something you'll have to deal with come tax time. Now, I mentioned it having a 1.6 coverage ratio instead of payout ratio because MLPs use distribution coverage ratio, which is the ratio of distributable cash flow to distributed cash flow. For example, if an MLP has distributable cash flow of $11.5 million in a quarter and distributes $10 million for the quarter, then the distribution coverage ratio is 115% or 1.15. So a coverage ratio of 1.6 for an MLP means that the distributable cash flow, or DCF, generated by the partnership is 1.6 times the amount of cash distributions paid out to unit holders. In other words, for every $1 of distribution paid, the MLP generates $1.6 of DCF, and don't get that acronym mixed up with discounted cash flow. A 1.6 DCF means it generated 60% more cash than it needed to cover its declared distributions, which is a strong signal of distribution sustainability, potential for future increases, and financial flexibility. That means they had a bunch of retained cash that could be used for reducing debt, funding growth projects, and/or for building a financial cushion for future distribution stability. A high coverage ratio provides a buffer against potential declines in cash flow due to market volatility, operational issues, or unexpected expenses. I think a coverage ratio of 1.6 is likely to boost investor confidence, as it shows the MLP is not overextending itself to meet distributions. However, an excessively high coverage ratio, like 2.0 or more, might raise questions about whether the MLP is being too conservative with payouts or under-distributing relative to its cash flow. So TLDR, it's a balance between rewarding unit holders and maintaining financial flexibility. Moving on, we come to my next holding in Goldman Sachs, which is 3.8% of my portfolio and which I find reasonably priced. I've got it being worth almost 4% down a year out, whereas analysts are more bearish with it being 7.3% down from here. GS has a 2.21% dividend yield, a 26% payout ratio, a huge 19% dividend CAGR, and a decent 13 consecutive years of dividend increases. Next up, I have Home Depot at 1.1% of my portfolio, and which I find expensive right now with its 1-year intrinsic value being 16.7% lower than it is today. But analysts are super bullish, pricing it up 12% from where it is today. Remember, my estimates are just based on what I think the business is worth based on its estimated earnings growth and such, whereas analysts probably include sentiment and macroeconomic conditions and a slew of other factors, like what their supercomputer is telling them will happen. Home Depot has a 2.44% dividend yield, a 46% payout ratio, a great 9.7% dividend CAGR, and a decent 15 consecutive years of dividend increases. Next up is the sister ETF to DIVO, and that's IDVO, its international counterpart, at only 1.14% of my portfolio. On average, analysts have IDVO basically flat from here. It's got a nice 5.57% yield, and it's only been in existence for a short period of time. I don't expect for income ETFs to have much dividend CAGR growth, or even stock appreciation, generally speaking. And that leads us next to my ticker, which is also an income ETF in JEPQ, which is 4.35% of my portfolio. Here we see that analysts are a bit more bullish with it being up about 6.6% from here, and it's been paying out a monstrous yield. JEPQ has performed better than I expected, basically matching the SP 500 total returns in its 3 years of existence. That being said, it has a variety of its own risks to be aware of, not to mention they normally pay out mostly as ordinary income, which can have tax implications for you. I bought my income ETFs with profits from other dividend stocks, so I kinda see them as gravy. Moving on, we come to a classic dividend stock in J&J, which is 4.78% of my portfolio, and which has been beaten down due to litigation concerns. I kinda like it when an otherwise solid company is out of favor in the market, as that means it might be a good time to buy, assuming you're right in believing it will recover. I find J&J reasonably priced, and I calculate it's about 4% underpriced relative to where I feel its cash flow and such will be a year from now, and analysts are in line with me as they see it up 2.7% from here, which overall would be a pretty crappy appreciation for most stocks, but the litigation is weighing it down. It's got a 3.13% dividend yield, which is quite nice considering its history, a 50% payout ratio, a decent 5.4% dividend CAGR, and an amazing 62 consecutive year of dividend increases. Next up is Kimberly Clark, which is 2.09% of my portfolio and which I find is reasonably priced, but with only 1% upside from here. Analysts are far more bullish with 12.6% estimated upside a year out, and it's at a 3.97% dividend yield, a 68% payout ratio, a low 3.4% dividend CAGR, along with an incredible 52 consecutive years of dividend increases. After that is another popular dividend stock in Coca-Cola at 3.3% of my portfolio, and which I find reasonably priced, as I estimated its intrinsic value should be about 1.8% above where it is today. Analysts are far more bullish on Coke with 12% upside from here. It has a 3% dividend yield, a 68% payout ratio, a 4.2% dividend CAGR, and 62 consecutive years of dividend increases. Next is another classic divvy company in McDonald's, which is 3.59% of my portfolio and that I find is reasonably priced, and I see it basically going sideways a year out. But analysts see it 10% underpriced. It's at a 2.37% dividend yield, a 59% payout ratio, a decent 7.3% dividend CAGR, and 49 consecutive years of dividend increases. I expect they'll hit the magic dividend king mark if they announce a dividend hike later this year, which I'm guessing they'll do. After that, we have a puff in Altria at 6.68% of my portfolio, and it's been on an absolute tear, outperforming the SP 500 over the last 5 years. I wouldn't have guessed that. I find it reasonably priced, as I see it still with some upward potential, but analysts are bearish and have it down about 5% a year out from now. Since stocks always have ongoing regulatory risks they face, so time will tell how Old Faithful performs going forward. It's at a 6.95% dividend yield, a 78% payout ratio, which is about where I'd expect it to be. It has an okay 4% dividend CAGR, and 55 consecutive years of dividend increases. My guess is we'll see a 4 to 5% dividend hike out of Altria later this month, which would take my annual Altria divvies from $15,500 a year up to $16,000 and something. Now I can understand if you're not a fan of stocks like this, but my mother-in-law smoked since she was a teenager, and so I feel it's nice that we're effectively getting some of her money back as time goes on. Moving on, next up is a stock that's not a classic dividend stock, though I think it will be someday, and I'm talking about Microsoft, which I find reasonably priced or expensive. My estimates tell me that Microsoft will kind of trend sideways for a year, though analysts are more bullish with it being 5% up a year out. But I'd also not be surprised to see Microsoft at an insane $600 in 12 months, because the AI realities and the hype will probably drive this faster than it should. Microsoft is at a low 0.66% dividend yield, a 25% payout ratio, a nice 10.2% dividend CAGR, and it has 23 consecutive years of dividend increases, making it almost an aristocrat. Next up is a classic dividend stock in Realty Income, which is 6.45% of my portfolio, which I find is cheap right now, with 14% upside from here. Analysts are a bit less bullish, with 7% upside predicted 12 months out. Interest rates have hurt O's performance, which is why we see it down at these levels, which to me means buying opportunities, whereas many others are running away. It's at a 5.68% dividend yield, has a low 3.6% dividend CAGR, and an awesome 30 consecutive years of dividend increases. Next up is another well-known dividend stock in Pepsi, which is 3.24% of my portfolio, and which I find cheap right now. Pepsi stock has been beaten down due to declining North American volumes, market share losses, underinvestment in brand marketing, and broader economic headwinds despite efforts to revive growth. But I see a strong 15% upside from here, and analysts have it as 8% up 12 months out. Pepsi's got a 4% dividend yield, a 70% payout ratio, a healthy 7.1% dividend CAGR, and an amazing 52 consecutive years of dividend increases. But is its dividend sustainable? I hope so, but I'd like to see better profits and free cash flow. Bottom line, right now could be a good time to get into Pepsi if it turns things around, but only time will tell. Next up is yet another classic dividend stock in Procter Gamble, which is 3.6% of my portfolio, which I find reasonably priced. It's about 4.6% too expensive as compared to analysts who see 12% upside. I hope they're right. It's got a 2.69% dividend yield, a 60% payout ratio, a 6.1% dividend CAGR, and an amazing 69 consecutive years of dividend increases. Moving on, next up is another sin stock in Philip Morris, which is 3.14% of my portfolio and which I calculate as expensive, being 12% overpriced, whereas analysts are quite bullish seeing 10% upside 12 months out. They're probably right given the environment we're in and the products PM has. It has a 3.42% dividend yield, a 76% payout ratio, a low 2.9% dividend CAGR, and a solid 16 consecutive years of dividend increases. After PM is Starbucks at only 0.86% of my portfolio, my smallest position. I wonder if Starbucks is still one of PPC's largest positions. If anyone knows, leave me a comment. I see Starbucks as a bit overpriced with 5% downside 12 months out, but analysts are more bullish with 2.5% upside. It's got a 2.6% dividend yield, a disconcerting 85% payout ratio, a healthy 8.6% dividend CAGR, and a decent 15 consecutive years of dividend increases. Starbucks has a new CEO and is engaged in transforming itself to turn things around and bring that payout ratio back to reasonable levels. They're trying to make investments in its employees, store operations, and customer experience. So those investments are a deliberate choice that, in the short term, can compress operating margins and impact net income. At the same time, the company's been maintaining and increasing its dividend payments as a sign of financial stability and a commitment to shareholder value, even as it makes those operational investments, which gets us to that high payout ratio. Bottom line, it has a variety of risks and headwinds, and time will tell whether Starbucks can turn things around. I think if the consumer gets pressed more, it'll be tough for Starbucks to have its earnings going in the right direction. Moving on, next up is a dividend ETF I own in SCHD, which is 6.47% of my portfolio. Analysts see SCHD up about 7% a year out, but I think a lot will depend on interest rates. If rates trend down, then dividend stocks and ETFs tend to get more compelling to investors, and thus SCHD would probably see more upside love. If we go into a period of higher rates, then SCHD will probably continue to underperform. I'm not worried either way, because over the long run I'm confident it will yield decent passive income and some decent growth. I like its algorithm, thus believe it will do what I need to do as a retiree. So a key takeaway is that I'm not investing in SCHD based on short-term market trends or trying to time interest rate changes. I'm investing in SCHD because it has a strategy that I believe will deliver on my long-term goals for retirement, which include passive income and capital preservation, regardless of the macroeconomic environment. That's why I don't freak out when SCHD underperforms for a while, just like I didn't freak out when the SP 500 underperformed. SCHD's got a nice 3.77% dividend yield, a very strong 10.9% dividend CAGR, which I expect will slow down, and it has an awesome 13 consecutive years of dividend increases. It's one of a handful of tickers I'd continue to hold and buy, even when the dividend doesn't go up every year, which I believe will eventually happen. Moving on, next up is one of my utilities in Southern Company at 3.13% of my portfolio, and which I find expensive right now, as I've got it down about 20% a year out. Analysts are also bearish, as they have it 17% down 12 months out. But hey, it's energy, and AI needs energy, so it could outperform unexpectedly. It's got a 3.14% dividend yield, a 67% payout ratio, a 3% dividend CAGR, and 23 consecutive years of dividend increases. And then the second to last of my tickers is Travelers at 1.19% of my portfolio, in which I find cheaply priced. I guesstimate that it may be up 15% a year from now, whereas the professionals have it up 8%. My gut tells me 8% is more realistic, but I'll stick with my original number. It has a low 1.73% dividend yield, a nice 19% payout ratio, a 5.1% dividend CAGR, and a good 19 consecutive years of dividend increases. Finally, my last ticker is Exxon Mobil, which is 3.91% of my portfolio, and which I find is reasonably priced, with only 2.6% upside 12 months out. But maybe I'm being a bit too conservative, as analysts have it up about 10% a year out. XOM has a 3.55% dividend yield, a 52% payout ratio, a low 2.4% dividend CAGR, and 42 consecutive years of dividend increases. And with that, I ask you to leave me a comment and tell me which of my tickers, if any, you own or plan to own. Also tell me what your favorite tickers are to invest in as of right now. Thanks, I really appreciate hearing from you guys. Finally, please show your support and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps me out. Now I'd like to shout out my newest Patreon aristocrats, so thank you to Defiam for signing up for a full year. I'd also like to shout out Spud Goat for signing back up as an aristocrat. Moving on, now I'd like to show my gratitude to subscribers who left me some really nice comments, so I'm going to shout out 10 who've done just that. So thank yous go out to RAKW, Tanya Schiller 9823, David O'Sullivan 1980, Shane Veltri, Mr. Lude TKE, Robert A. Smith FE 6509, Chuck Kahn NYC, Brock New Miller 448, Div INV, and then multiple nice comments from Not Today Satan. Thanks folks, I really appreciate it. Now I'd like to recommend that people check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'd also like to pitch my Fast Crafts affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.